So we are going to today to start with section A questions, and hopefully if we have some time we'll go look at section B questions for the first chapters that we are covering as per the video shared. And the reason is because those two chapters don't usually get set in section C. They are usually section A and B questions. So the first one is going to be regarding financial management function and then financial management environment. Basically, like what you have to know about the financial manager is that he has some roles that he actually does when it comes to the business. And those are the roles that we are going to be looking at here. So we shall first understand what he does, and that's the function. And of course, the environment in which the finance manager operates, being the financial management environment, because there we shall be looking at if the manager wants to control, for example, working capital, how does he go about it? Where does he even start? Who does he consult? Those kinds of things. So together, when you understand those two perspectives, then you have this grasp of what the finance manager does, and therefore, when it comes to now looking at the sections that talk about exactly now what he's doing, like working capital management, investment appraisal, business finance, and cost of capital decisions, valuing businesses for takeover, or that kind of stuff, and then managing risk. And those are the different roles that the finance manager will be doing. So you see that we start from what he does, where he does it, and then for after we know that, then we can go to each of those roles and now see how exactly does it do it. So that's the logic that we are using for this. So let us actually now go and start with the section A questions. But of course, before going there, we have, when you look at this kit, you have analysis of how the questions are being set. So you can look at them and they are arranged based on this ACCA syllabus. So you can get to understand how examinable and non-examinable each of the sections are. But remember, this is just a sample space of the papers that are recent. So you don't look at it and say, okay, they don't set this paper, they don't set this topic. So you have to prepare for all of them. But of course, the ones that have been set in the most recent sittings give you an idea of where you should focus your strength. So please remember, saying don't sport, but that means that it doesn't mean that you don't have to put some energy somewhere more than the other sections. So as the question sections actually would be iterating. So you get some time to read through the technique. Basically, they're saying you have section A, you have B, you have C. You have to manage your time. You have only 180 minutes, so 1.8 minutes per mark. So you just multiply that by the different marks that are allocated, and you know how long you are supposed to spend on a question. So that you will read by yourself. So for us, let us now go and look at the first questions. So all this is very important for you to read. And also there is a schedule here that can help you when you're preparing for your exam. For each topic you come here, you look at the topics, the questions to attempt. Then you can look at when you attempted them and you see whether you are good in that topic. So this is a good kit, or a good tool that helps you to monitor your progress far as the questions are concerned. So we're going to start straight from the first financial management function. And basically here, the first question they're asking us is that when in relation to financial management of a company, which of the following provides the best definition of a firm's primary financial objective? So basically, the financial objective of the company, the primary objective. So you can see here you have long-term growth in earnings, maximize level of annual dividends, maximize wealth of the ordinary shareholders, and maximize the level of annual profits. So Now, ideally, we are asking for the primary financial objective. And whenever you see that primary financial objective, it is all about the shareholders, maximizing their wealth. So maximizing shareholders' wealth is the primary financial objective of a company. In this paper, we don't look at mostly non-profit organizations because those ones usually have different objectives, which are sometimes different from the financial ones. Some of them, they look at service provision and all that. But when it comes to the financial organizations, the reason why you are hired as a financial manager is to maximize shareholder wealth. So that is the answer will be C in this case. Then they ask us to indicate by clicking on the relevant box whether the following objectives are financial or non-financial for a company. So as opposed to having financial objectives, you don't need only to have those because a holistic company should be focused on not only meeting its financial objectives, but also the non-financial objectives. Because I'm sure most of us are working and we know how we use those balanced scorecards to assess performance and all. When you are looking at performance, it's going to be short-sighted to only look at financially speaking how somebody performed, because then you are leaving out some things like customer satisfaction, which are items that later on translate to actually finance, translate to money. So now, if you go and start looking at the first statement, maximization of market share, that is of course a financial objective. Then, so this is a financial objective. Then earnings growth is financial. Ideally, you are looking at those objectives that have to do with the money aspect. Increase in sales revenue is a financial objective. Then achieving target level of customer satisfaction. Now, customer satisfaction is not a financial objective. And then achieving target level of return on capital employed is a financial objective. Now, there is one objective that I've put as financial up here, say market share. But if you look at market share, what is market share? Market share just basically represents the proportion of the total customer base that you actually own. For example, when you look at MTN and the people that are using SIM cards in Uganda, when you're looking at market share, you are looking at how many people use MTN. So although this translates to a financial metric, but in its own, it is not a financial objective. I don't know if that is very clear. So I put it there, but it's not a financial objective because it's just telling you how many customers you have. So again, even if it is not a financial objective, like as you can see this one also, but you can see that these are easy for you to translate into finances. For example, when market share is big, means that you increase your revenue. Also, when customers are satisfied, it means that you have repeat business, and that means also increased revenue. So non-financial objectives in their nature translate to financial objectives if you are looking at them. And this is one of the reasons why it is important to monitor, to make sure that you are monitoring not only your financials, but also your non-financial objectives. So if you have a question as we go, you can stop me. But if you don't stop me, I'll just proceed. So we have the next question asking us about which three of the following are the main types of decision facing the financial manager. And we already talked about this when I was introducing the topic. The financial manager is responsible for a couple of decisions. And the first one, income decision, So this one is not a decision that a finance manager does. Now, what you need to know about decisions is that decisions are supposed to be about things you can control. So you cannot control how much income the company earns. So there is no such thing as income decision. So that is not a decision the finance manager does. But investment decision is a decision because as a finance manager, you need to decide whether to invest, for example, in a new building or whether to put that money in a fixed asset so that you can earn your interest, or whether you can diversify. There are many decisions that have to do with investment. That is one of those roles that a finance manager actually has to do. Then there is a dividend decision. That is also one of them. When a company makes money, you need to give back that money to the shareholders because basically you are making shareholders money. So the decision there that has to be made would be, should I give all this money back? Should I keep some and invest it? How much should I give them? Should I keep giving them the same dividend every year? Those are part of the decision for the dividend that you can give. That is okay. Then financing decision is one of those ones because as a finance manager, you need to get money to actually run your business. And then you need to ask yourself, should I use equity or should I use debt? So that is a decision. So when it comes to appraisal and budget decisions, these are not decisions the finance manager makes. Appraisal decisions can be made by the performance management team when it comes to the employees. Then the business decision, this budget decision, this one is basically again for people who are planning, but at operational levels. So these are not decisions of the finance manager. Finance manager deals with these three here, among others that we are going to look at later. Okay. So then we have another question here which says, which two of the following examples of financial objectives that a company might choose to pursue? Again, here we have been asked to talk about financial objectives. And here, dealing honestly and fairly with customers on all occasions, this is not a financial decision, okay? So this is a non-financial decision, but it's going to affect customer satisfaction and basically bring back revenues in the long run, but it's not financial. Providing good working conditions and industrial relations, this is also non-financial. It's about stakeholder stakeholder engagement or management. So looking at the different stakeholders, remember the company has different stakeholders, shareholders being the most important, but you need to look at the other stakeholders like the employees, suppliers, customers, and the like. Then earning above a particular level of return on capital employed. So that sounds like a financial decision because you are looking at earning above a capital employed level. So that's a decision. And this decision in this case, you would be looking at it in terms of, okay, I have this project and this other project. This project brings me 2,000, the other one gives me 3,000. Then you calculate return on capital employed, then you determine which one you should actually accept. So that is one of those we shall see later on. Producing environmentally friendly products is not financial. It's about being environmentally maybe conscious, and therefore that will go to the non-financial side. Then restricting level of gearing to below specified target level. So gearing, as we shall see, this has to do with the financing decision, which we already talked about before. How much debt should you have in your business? So they wanted two. So we have C and E. So then they ask us again, which of the following actions is consistent with increasing the value for money? So when it comes to non-profit organizations, because I said they don't mostly probably look at financial aspects, but they have what we call value for money. So value for money basically looks at the three E's: economy, efficiency, effectiveness. And I'm sure you've heard about these ones several places before. It's not going to be the first time you're hearing about them. But those are the three E's that the non-profit organization will look at. And now they're saying which of these actions is consistent with increasing value for money. And now when you look at what is being given to us, using cheaper source of goods and thereby decreasing the quality of the organization services. Now, when you're looking at value for money, you don't reduce the cost at the cost of the quality. Okay, so this is not something that you would ever want to do. So that is not a correct answer. Searching for ways of diversifying the finances of the non-profit organization. So diversifying finances, this is not to do with the value for money, because diversifying finances basically is usually for the organizations that are making profit, because they are the ones that are concerned with the financing and and how their money is being invested. Decreasing waste in the provision of service by the non-profit organization. This one is something that you can see being in this value for money, where you are looking at decreasing the waste. Okay, so, and it will be, for example, under effectiveness. For example, you'll be like, okay, what maybe my role is to provide education for the community, but then how can I provide education for the community without destroying the environment? Perhaps maybe you're saying you are using less firewood maybe for cooking for the students. Perhaps you are saying that you are using and instead of using books that you keep on maybe throwing after they are used, perhaps you could maybe say you are using tablets. So something that is reducing waste. So that can be within the limelight of NGOs, because they are going to be concerned with the environment as one of the points that maybe they have as the objectives. But financially speaking, that comes as a like an afterthought. So first we are looking for one point, but we can look at the others. Meeting financial objectives. So this is not something that NGOs usually think about so much. They usually look at providing the service. Okay. Then we can go on and look at the next question, which says, which of the following is least likely to fall within financial management? So financial management, as we saw, is going to be looking at the roles that finance manager does. So you just look at these ones, see which one doesn't fall in there. So dividend payout to shareholders is increased. So this is about dividend decision. That's okay. Funds are raised to finance the investment. That's about financing. Surplus assets are sold off. That is investment, because basically you are looking at how you deal with when it comes to investment, you look at how you deal with your assets. How do your assets bring you money? So if you realize that some of your assets maybe are not giving you as much return when you are using them, and it makes sense to sell them, that's also a decision you can make. But if you are comparing actuals to budget, this is performance management. So that is not financial management. So the answer is in this case D. Then here they want us to indicate by clicking in the relevant boxes whether the following statements are true or false. So financial management is concerned with the long-term raising of finance and allocation and control of resources. So from what we have talked about, I am sure I should agree that this is true. Then we have management accounting, which is what we did at level 2. That was level 1 actually. Is concerned with providing information for the more day-to-day functions of control and decision making. So if you look at financial reporting, because we have all the three here, financial accounting, management accounting, and financial management, which you have already said it's true. So normally the difference between financial accounts and management accounts is that financial accounts are made for the shareholders as the external external stakeholders to see whether the accounts of the company are as they say they are. And the auditors normally come and verify that. So they look at historical results of past plans and decisions to see this year how have we performed. So this is true for financial accounting, whereas management accounts are usually internal and they are mostly used to have things like budgeting, to make sure they are controlling the costs within the organization, and also managing the day-to-day functions. For example, you want to see whether you should allocate more money to the operations department. So you can do management accounting. You look at how much they are currently having to spend, what are they using the money for, those kinds of decisions. So this is also a true statement. So management accounts are internal. They are for helping with decision making and control, whereas financial reports are provided to the external people to look at how the company has done across the 2 periods, usually, or 3 periods, so that they can see if they are performing well or not. Then they ask us, so which of the following tasks can be carried out by the member of the financial management team? So I'm sure by now you can start to realize what question, how you can easily get these ones, because we are still looking at the role of the financial manager. So if you look at what we have here, we are going to just look at which of these ones fall under those roles that we have looked at. So evaluating proposed expansion plans, this seems like they fit, because expansion plans are to do with the investment decisions. Should I expand to maybe another country, or should I acquire another company and merge? And of course, we can look at the other points to exclude them. Review of overtime spending. This is not something that is a financial manager perspective, but this can be a performance management kind of thing. Then depreciation of non-current assets. So now depreciation is not a financial metric. It's basically a metric that helps us to look at how we are utilizing our assets. So we divide the asset over maybe a useful life of 4 years, and finance managers won't be bothered with this. As far as they are concerned, once the asset is bought, they just look at how much money is bringing, not how it is being depreciated. So we shall see when we are calculating, we don't actually look at that calculation. Then which of the following examples of internal stakeholders in a firm? So I've been talking about stakeholders, and I said we have external and we have internal. And the external ones are those that are not within the company, whereas internal ones are those that are within the company itself. So looking at that, we are looking for those ones that are in the company. So we can have here directors. Yes, these are in the company. Customers are not in the company. Suppliers are not in the company. Employees are in the company. And then these ones, the financial providers, are not. So these two are internal because they are within the company itself, whereas the remaining ones, the customers, suppliers, and financial providers, those are all external stakeholders. They are related to the company, but they are not in the company. They are not directly involved in the company. So then we see here another question asking us for the purpose of corporate governance, main purpose of corporate governance. So now this is something that you ought to know from those early papers of level 1. And I don't know if I know that most of you get exempted for those papers. So if you don't know it, probably you know it from your work or something. But corporate governance basically looks at how an organization is going to be effectively managed. Okay, so we look at, in that case, how many people should be on the board of directors? How should maybe the directors be paid? Uh, how should be the split between executive and non-executive directors on the board? So those are the kinds of questions that corporate governance answers. So if you look at the main objective, as I said, is to facilitate effective management of the organizations and to make them more visibly accountable to a wider range of stakeholders. So this is the answer. But if we look at the others, so to separate ownership and management control organizations. So now, when they say main, you have to realize that, okay, and I'm giving you this as a technique for answering multiple choice questions in section A and B. When you see words, the so-called qualifier words, like, for example, always, main, not, and others, as we shall find them, you need to read the statements carefully, because when they don't say main purpose, you can see that this is actually a purpose. Because corporate governance, at its core, it looks at how do you manage organizations. And one of those ways you can do it is to make sure that you have management and control being separate. But the reason why that is the case is actually because, as we shall see, the chairman and CEO, if they are the same people, there are some issues that can arise when it comes to those board resolution and everything. But this is not the main objective. Maximizing shareholder value, this is an objective, as you can see also, but it's not the main objective, because actually corporate governance is trying to bring in the directors so that they are able to do as is expected for other stakeholders, not just shareholders. Because ideally, what used to happen was that directors would come and work so hard to make to shareholders happy, but at the expense of employees, paying them very little money, forcing them to work longer hours and all that. Because for them, all that mattered was to make their shareholders happy. So corporate governance came to remove that, basically by saying, okay, shareholders are happy, but also employees make sure the employees are also not having issues, make sure customers are not disgruntled because the quality is not good, such things. So, and then also ensure that regulatory frameworks are adhered to. Even this one, corporate governance, actually, when you look at it, it also focuses on it. But again, it is not the main objective. So what I'm trying to say here is that the reason why the point C is the correct answer is related to the fact that it is the main objective of corporate governance, effective management of organizations, and make sure that they are accountable to a wide range of stakeholders. So if you don't have an idea of what corporate governance is, you can as well look at the video as I shared, or you can always go to the notes and just take a read about that so that you can get a better grasp on it. This question looks at the agency problem. So the agency problem basically is the situation which arises when directors, because directors are not the owners of the company, ideally, but they are the agents to the shareholders. So the agency problem arises when the shareholders are interested in something different from what directors are interested in. So the directors may start doing things that benefit them as opposed to the shareholders. So now, and they are saying it is the driving force behind the growing importance attached to sound corporate governance. And they are saying in this context, who are the agents? Okay. And from what I've told you, the directors are the agents to the companies, to the shareholders. And therefore, it's not the customers, it's not the shareholders, Definitely not auditors, because auditors are just employed to come and review the books of accounts. So it's the directors, or in this case, managers, because the directors and managers sometimes are interchanged in terms of what they call them. Okay. Then which two of the following statements are correct? So we have maximizing market share is an example of a financial objective. And of course, this question, if we look at it, we already talked about market share and we said that is not a financial objective. It is actually non-financial. So this is not going to be correct. Stakeholders' wealth maximization is the primary financial objective for a company listed on a stock exchange. And this is correct, okay? Because when you're listed on a stock exchange, it means that you're a company which is actually means that you are a company which is in it for profit. Okay, that's why you are listed. You don't find NGOs listed on stock exchanges. Then financial objectives should be quantitative so that their achievements can be measured. So, of course, this is true because there is no such thing as somebody saying to improve profits as an objective. Okay, so they normally say to improve profits by 20%. So it has to be quantitative but also measurable. Then, first we are looking for 2 points, and we already have the 2 points. But just look at the last one. The 3 E's are used as a performance measure to assess value for money in non-profit organizations. The 3 E's stand for economy, efficiency, and it's not environment, it is effectiveness. Now, if you are in an exam and you are very fast and you are looking at it, you look at these two and you say this is correct, you have failed. Okay, so this also teaches you to take your time and read the question clearly so that you answer exactly what the question is asking for. Take your time doesn't mean that waste your time. It means take enough time, but time which is this. Because anyway, what you need to realize, although we said 1.8 minutes per mark, there are some marks that you can get very fast. Like this one, if you know it, you read it very fast, you have finished. Although we are going to find others where you have to calculate. So there's a time when you spend less than the time for the question, and then you now have extra time that you can take to another question which needs it. So you have to do that balancing game. But at the end of the day, make sure that you are finishing section A within its time, and then you go to B within its time, and then you go to C. And also when you go to section C, you have to make sure that you give the time necessary for each question, ideally equal time for each question, so that you are able to attempt all the questions. Now, which two of the following are efficiency targets? So now we are looking at the 3 E's in details, and we are looking at, they are telling you here to choose 2 things that can represent efficiency. So, reduction of wastage of paper. Remember, efficiency means, okay, and I know you're going to watch the video, so I'm just putting some things here, but as we said, we have 3 C's. We have 3 E's. We have economy, and economy basically talks about something being done at a cheaper price, okay, but without compromising quality. Then efficiency means achieving your objectives or getting the best out of the cost that you have. So economy, you already spent less, but then now let's say you are looking at how efficient you are. Like for example, when you are referring to like somebody doing something, that could be how fast they are able to do it. because that also ends up saving you money. So you are here looking at saving based on the cost that already exists, but how are you able to improve on that? Then effectiveness is basically achieving your objectives. So let's say your objective is to make sure that you have people pass, then they can judge you on how many people passing. And here they're asking us for efficiency. So reduction of wastage of paper, that means that how are you utilizing the paper that you have? So that is efficiency. Okay, that's efficiency. The pay rates for staff of appropriate level of qualification. This is now economy. Okay, you are looking at the cost that you are incurring. So that means that is economy. Staff utilization, as you can see, this one also is going to be efficiency, because you are saying, if I have 10 people, how am I allocating the work such that each of those people is used optimally? So utilizing your resources to achieve your objectives. So that is, so those are the two that we are looking for efficiency. And customer satisfaction ratings, this one is going to go for effectiveness, okay? So for example, your goal is to satisfy customers, so you look at how satisfied they are. That is effectiveness. Okay. Then we have another question here looking at managerial reward schemes. Should help ensure managers take a decision that is consistent with the objectives of the shareholders. And they're saying which three of the following are characteristics of a carefully designed remuneration package. So, of course, when you go and read through, when it comes to enumeration, and most of you may actually maybe know about it, but this is if you're paying the people, what is the characteristic that that package should have? So if we read through them, we shall see which one is the correct answer. So you see, linking rewards to changes in shareholder wealth. This is a good one. Like, for example, as directors, they should be able to have this incentive of saying, okay, if you increase shareholder wealth by 40%, there's a bonus. That makes sense, because it means that they are working to satisfy the shareholders, which is what we call goal congruence, having the same goal. Matching managers' time horizons to shareholders' time horizons. So now, here, again, we are looking at matching the time horizons of managers to the shareholders. So again, we are looking at goal congruence in a way, because imagine the shareholders' time horizons, for example, are different. Let's say shareholders are expecting to have growth of 10% in 1 year. So that's what they want. But then managers are expecting to get 10%, but in 6 months. So you see that is not fair to the managers. You can't be giving managers an uphill battle for achieving a goal in a short period where shareholders expect it to be in a year. But the same way you can't do that, you don't also expect to give managers responsibilities whereby the time horizons that you give them are lower, so that you are higher. So, for example, you say, for example, the director has increased revenue by 10% in 2 years, they get a bonus. Whereas shareholders want 10% per annum. So that means that you shareholders are not happy about your bonuses. So basically, let it be at the same level of expectation for both. So that is also something that is going to be part of a good package. Possibility of manipulation by managers. That's not a good thing. Okay? Because if managers are able to manipulate their package, that means that they can increase their salary without necessarily having a reason, or without necessarily actually being like in the right when it comes to that. Because like, of course, you want to reward people for good work, but you don't want to have people reward themselves when they have just manipulated the results. So package should not be manipulable. Then, of course, encouraging managers to adopt the same attributes to risk as the shareholders. This is also a good thing. You can see that if shareholders' risk appetite, as we shall see, risk appetite can be high, low, which you can say we are risk averse, we are risk seeking, or risk neutral. You don't want to have directors who have a higher risk appetite than the shareholders because they'll be investing in things that shareholders do not like because they are more risky. But for them, they deem them fit because they have a higher appetite, which is not good. So that's also a good point. So, and then therefore, since we are looking for three, we know we have got them. But if you look at this other one, motivational to primary achievement, motivation to primarily achieve short-term goals, this is actually wrong. You don't want people to focus on short-term goals because then the long run, the company suffers. Then, of course, here they are telling us to indicate by clicking in the relevant boxes which of the following are typical criticisms of executive share option schemes. This is one of now those questions that are very specific. And if you have no idea what share option schemes are, this is where you should go to the textbook and look at what that is. But ideally, what we are saying here is a share option scheme means that you tell the directors that, okay, as part of a bonus, we can give you share options. And share options basically can usually have conditions whereby they say that you have the option to actually buy shares in a company and become a shareholder, but those options maybe can be exercised within the first 5 years. So if you stay within 5 years, and they could have conditions that maybe if you have achieved this much profitability over those years. So those are some of the things that can be there. But the options basically allow the directors to essentially become part owners of the company. Now, so now we are looking for criticisms. And one of them, they're saying that when directors exercise their option, they tend to sell the share almost immediately to cash in their profits. And this is actually a right criticism. What happens with directors is that they don't intend to be part owners of companies. So whenever you give them share options, they just wait for those options to reach a point where they can exercise them, and they get the shares. And the shares usually they get them at a lower amount. So when they do get them, then they do what? Just give me a second. Okay. So as we said, when these companies actually, when the companies give directors share options, they usually exercise them and sell them immediately. So when they do so, uh, the company doesn't benefit from what the intention was because they are selling them directors at a cheaper price. Then the share price falls when the options have been awarded and the options have no value. They cannot act as incentive. So, okay. So that is also a criticism because you see, the share options only become better if you are able to benefit from them. So if they tell you that as a director, I shall give you a bonus, but in terms of share options, where you can get these shares at maybe $2 per share as the value that they are going to give them to you. So if the share price falls below that, So it means that when you get them and you exercise them, you may not actually end up being able to sell them and get a profit. So it end up not being so much of an incentive for you. So you may be like, okay, but why? What's the benefit? What's the main benefit for this? So that is one of those that we can also take to be the criticisms. Then, if you look at the third one, says that directors may distort reported profits to protect the share price and the value of their share options. Now, if the second one is correct, that means the third one is also correct, because you see, directors are going to be benefiting if the share price does not fall. And share price is basically going to be something that is computed based on what the earnings per share represent. And the earnings can be manipulated because they just represent how much money you have earned in a year and all that. So they can be manipulated. So they can distort the results so that they can make sure that the company is performing. So there are some scandals that you see that are rising just as a result of that, because directors keep on portraying at this image that this company is performing better, yet in actual sense they are not, but because they are trying to protect their share price and therefore benefit from that. Okay, so all the three of these ones are criticisms of the executive share option scheme. Then when we move on to question 16, directors of Portico have recently engaged a firm of consultants to negotiate standard terms of trade of one of the strategic business units. This includes the agreement by Portico to pay 5% penalty on any late invoice settlement. So now, this policy is an expression of the company's concern for which major stakeholder. So now, here what we are looking at is just understanding what this statement means, because you see, when you look at the statement, they are saying that their directors have engaged a firm of consultants to negotiate terms of trade for one of the business units. But the agreement says that Portico should pay 5% penalty on any late invoice settlement. So Portico is a company. So which invoices does it settle? Suppliers' invoices. So when the company basically sells to Portico, or when Portico buys from that company, then that company may be worried that Portico is not going to pay them on time. So if they are paying them late, then they are saying, let us put that Portico pays 5% penalty. So this is actually for the supplier's benefit. Okay. So we let's see how many questions are left for section A. There are still a couple of them, but I think what we are going to do is to take a break of 10 minutes, that we come back at 10 past 8. And then we are going to, when we come back, we are not going to continue with these ones. We are going to skip to financial management environment. There are just a few questions. Okay, maybe we can cover them, but we can as well leave them, and okay, we shall cover them, then we shall go to the next part section. So let us take 10 minutes. We return at 10 past 8. So let's first finish these questions from this, so then we can go and look at the rest of them. So here they're saying that under the terms of the UK Corporate Governance Code, what are the only types of directors admitted to sit on a company's audit committee? Now, again, this is from the Corporate Governance Code of the UK, and this is very from level 1, although in the textbook already it's there, but they are asking us for the two people who can be on the audit committee. So only type of directors, and the answer is independent non-executive directors. So remember, the audit committee is to do with a committee which appoints, first of all, as recommends external auditors, but also is responsible for the internal audit function of the company. So you don't want directors who are executive directors actually part of that committee, because basically you are checking their work. For example, you don't want the finance director to be part of the committee when they're auditing their financial statements and all the financial operations and all that. So they have to be non-executive directors, but they have to be independent. And that's why we have two answers here, which have the non-executive directors, but the answer should be independent non-executive directors. So then which of the following would you expect to be responsibility of financial management? So producing annual accounts, we have already looked at financial managers and what they do. So they don't produce financial accounts. Those are financial accountants. Producing monthly management accounts, that's not the ones as well. Advising on investment in non-current assets, that's what they do. Then rates for staff, not really. So those are the roles of the financial manager. By now, there should be something that you can actually see, because we have looked at most of them here. They want us to indicate whether the following statements are true or false. So they're saying that value for money is usually taken to mean economy efficiency and engagement. And as you see, it is not engagement, it is effectiveness. So this is false. Come dividend means the buyer of the share is entitled to receive the dividend shortly to be paid. This we shall see when you look at the financial management environment. But basically, I can tell you, normally we have ex-div, and then we have come div. And ex-div means that the dividend has just been paid. And therefore, if you buy shares ex-div, means that the shares that you get don't have dividends, at least for a year. Whereas come div means that you have bought shares that are entitled to dividends shortly after. So this is true. This is like buying a chicken which is about to lay eggs. So that's come dividend. Then dividend payout ratio compares the dividends per share with the market price per share. So that's not true. So this question here, it has some parts that that if you watch the video, they might be clear, but if they are not clear yet, they will be clear as we go through the other chapters. So you can actually at least bear with that. Then agency problem means that the shareholder wealth is not being maximized. That is true, because we said that if the directors are doing what they want, it may not necessarily be what is good for the shareholders. So that is actually the agency problem. So now here they're saying increasing which two of the following would be associated with financial objectives. So again, this one here is basically looking at financial objectives of shareholder maximization. So if you increase share price, that's okay. If you increase the dividend payment, so dividend payment, this is about financial objectives. That is also true. Whereas profit is not a financial, profit is not actually a measure of shareholder wealth because it can be manipulated. So usually we don't consider it, we normally consider cash flows. Earnings per share, which has the element of profit, and then weighted average cost of capital. So these are not like increasing earnings per share, increasing weighted average cost of capital. These are not regarding with the financial objectives. So to move on, ARP is clearly providing ARP charity providing transport to people visiting hospitals. Which of the following performance measures would best fit the efficiency in a value for money review? So here we are looking at efficiency, so utilizing your resources optimally. So if you look at those ones, we have a percentage of members who reuse the service. That is not basically, because we are looking at effectiveness, efficiency, so how we use your resources. So this can be actually effectiveness, because this is like an objective. Then the car per journey hospital. Actually, this is something, because if people are using the cars to go to hospital, you want to know, like for each journey, how many cars, how much is it costing you to take people to actually the hospital? So the cost per journey to the hospital, that can be something that can come to efficiency. Then a comparison of actual operating expenses against budget, that is going to be like cost, which is economy. A number of communities served is also effectiveness. And then we have a state-funded hospital has the objective of providing value for money, measures the achievement of the objective using the 3 E's. Which of the following performance indicators measures hospitals' economy? So here we are again looking for the cost aspect. Patients admitted per year, that is effectiveness. Total medical staff salary cost, this is what we are looking for. This is the economy. So cost. Then cost per successful treated patient, that is efficiency. Because efficiency, although it has their cost, but it looks at how do you achieve the objectives at the lowest cost. So normally it's going to be cost by this, cost by that, try to monitor how much it's costing us for each of the things we are doing. Average waiting time for patient admission to hospital, this is also effectiveness. Okay, so those are the questions from section A regarding the financial management objectives or the roles the financial manager does. Then we can now look at the environment in which they operate. And here I noticed that I think, okay, I think it's safe to say none of you watched the video, because I was checking to see in the classroom link, and I think Priska had not watched the video yet as well. Did you watch the video, Priska?
I didn't watch. It was telling me login details. I didn't have them.
No, in the login details are for Google. Like that Google Classroom is, you use your Gmail account to log in. But anyway, you didn't reach out for me to sort that. But anyway, I'm going to, because okay, let's see how these questions go, because some of those aspects that are here, you needed to have watched the video, but let's see. But then I'm going to, at least for this video, share it in WhatsApp, a YouTube link, so that you can watch it. And I think even for next week, then after I set up everything and you are able to log in, I keep putting them there in the classroom. So they're asking here, which of the following is or are among the elements of a fiscal policy? So you need to understand what a fiscal policy is, but basically a fiscal policy is how government manages basically two things, taxes and also how much it spends, government spending. So there are two, there is monetary policy and there is fiscal policy. So if you look at Bank of Uganda has those responsibilities to control the fiscal policy and also the monetary policy. And as I said, in the fiscal policy, we normally have taxation and then government spending. So therefore, government spending, which is point number 3, and also raising or lowering tax, which is point number 1, giving you the answer here as B. And then monetary policy has to do with the supply of money. So basically, how much money is in circulation? So that is monetary policy. Then which of the following statements are correct? So the first one says securitization is the conversion of liquid assets into marketable securities. So we shall see. This is called securitization, not securitization. Securitization. So we have what we call securities, and these are traded. So market securities are traded. So when I say securitization, now it means that I'm saying, how can I make things that were not traded become traded? So, for example, when you look at the 2008 crisis, they did this. So people used to get mortgages, and mortgages never used to be traded. The bank would just have a mortgage and then you keep paying it. But then they started packaging them and then trading, putting them on the market. And people would keep on buying those mortgages as the so-called mortgage-backed securities, and they would sell them amongst themselves. So people invested so much in that. And when the market for housing collapsed, that also came down tumbling. But so this statement is correct. Securitization means you get something that was not marketable, something which is illiquid, and then you convert into something that is marketable, that you can trade on the stock exchange, on the money market. Then the reverse yield gap refers to equity yields being higher than debt yields. So we shall see, or when you watch the video, you will see that when it comes to the yield, yield just means how much return is for a given security. So could be you are looking at security like a debt instrument, or you can be looking at maybe equity instrument. So now the reverse yield gap actually is when debt is higher than equity, because ideally equity is more expensive than debt. So, and the reason why that's the case is because equity shareholders, for equity, it's shareholders, and the shareholders take on more risk than the debt holders. Because a shareholder, when they have ownership of the company, they means that they benefit from the gains, but also the losses. And also, when they are getting paid, they are paid only when the directors declare a dividend. Whereas debt holders, for them, they don't benefit, they don't suffer losses usually. When they give you money, you give them interest every month or every year, and you pay them their principal at the end of the loan period. So they don't care whether you're making profits or losses. So because of that, debt is usually cheaper. So if debt becomes more expensive than equity, then we have what we call a reverse yield gap. So that means this statement is not correct because it's saying the other way around. Then this intermediation arises where borrowers deal directly with the lending individuals. This is correct. Basically, what normally happens in normal cases is that you have here somebody, person one, and that somebody wants to get money. But instead of going to person two, they go to the bank. Now, in the bank, this guy deposits his money to the bank, and the bank lends this money to this person. So that's what we call an intermediary. So when you do what we call this intermediation, you are basically removing the intermediary. removing the bank in this case, such that the borrowers and lenders can meet and directly deal with each other. So that is also correct. And we are looking for 2 correct points. So that's it. But if you look at the other point, it's asking for demand pull inflation, saying that it occurs when there's increase in products dependent to the state of demand. Now, of course, what that is describing is not demand pull inflation. It's actually, so inflation basically is the increase in the price of the commodities, general increase price of commodities. And it has 2 effects, 2 causes. We have what we call demand pull inflation. Then we have what we call cost push inflation. So demand pull inflation just means that, okay, if there is a lot of demand for something, then by the principles of demand, that the price is going to increase. So that is what demand pull inflation is. Because there is so much demand for something, the cost of it increases, and therefore inflation occurs. But on the other hand, cost push inflation, for it, it's not related to the demand. Like, you can still have the demand not changing, but the price increases. So when the price increases, irrespective or independent of the demand, then that we call cost push inflation. Because in that case, it's not the demand, but it's just that the people who are making the product are increasing the price, or there is general increase in price, which is caused by other things that have nothing to do with the demand. So this is not correct. So you have point 1 and 3 being the correct answers to this. So if we continue, now here we have been given, indicate by clicking the relevant boxes whether the following statements are true or false. And the first one says, coupon-bearing securities have a fixed maturity and a specified rate of interest. Coupon-bearing securities. So this is correct. The environment in which the finance manager operates can include a money market or can include a stock market. On the stock market, if you normally find there shares, but also debentures. These debentures are called loan notes sometimes, and those ones are usually coupon-bearing securities. So a coupon in this case is going to be how much interest you'll be earning on that security for a given period. So they will have a fixed maturity and a specified rate of interest. So they can tell you that this is an interest rate of 4%, and you're going to earn it for 5 years. So that is true. But also, in the discount market, funds are raised by issuing bills at a discount to the eventual redemption or maturity value. That's also correct. So that's what we call a discount market. So now, then we have the principal objective of macroeconomic policy include which of the following. So again, this is something that is in the videos, but basically that is what government is trying to contend with, and we have some of those things that we talked about there of the fiscal and then monetary policies. So what are they trying to do? They want to make sure there is full employment of resources. That is correct. They want to ensure economic growth. That's correct. And then also price stability. That's correct. But balancing government budget is not. So So basically, when you look at what government is trying to do with the Bank of Uganda, it's basically trying to make sure that the resources of the country are fully employed, which resources can also include the people, but also funds that the government has. So Bank of Uganda is responsible for investing government resources when we have surplus, but also ensuring that there is no inflation. So by ensuring price stability and also economic growth. So those are the three objectives. So which means that the answer here will be C. Then when you go on, they say that governments have a number of economic targets as part of their fiscal policy. Which two of the following government actions we release predominantly to relate to fiscal policy? So we have talked about these two policies before. So here they're asking us which ones relate to fiscal policy. So the first one, decreasing interest rates in order to stimulate consumer spending. Now remember what we talked about fiscal policy. So fiscal policy, we said, has to do with the two things, taxation, but also government spending. Okay, so those are the two things that we are going to look at, taxation and government spending. So it means that if you are looking at interest rates, that's not one of them. So interest rates is basically monetary policy. Reducing taxation while maintaining public spending, this is one of them. Using official foreign currency reserves to buy the domestic currency, this is monetary policy. Then borrowing money from capital markets and spending it on public works, this is government spending. So that's correct. Then regulating foreign exchange rates, that's also monetary policy. So the answer in this case is B and D. Then, which three of the following are key roles played by money markets? So, providing short-term liquidity to companies. So, money markets, as we said, there are two markets, as we shall see in the video. But the first market is called the stock market. And that one is usually for shares and debentures, and it's usually for long term. Then money markets are usually for short term. So money markets can provide short term liquidity to companies, that's okay. They can provide short term trade finance, that's also okay. And they allow organizations to manage exposure to foreign currency risk and interest rate risk, which is also okay. So on the money markets, that's where you find the foreign exchange trade happening. Then dealing with long-term financial transactions, that is not money markets, that's the stock market now. And then allowing companies to issue shares to raise money, that's also the stock market. So here, these are the three roles of a money market. So if we continue, so here they're asking for the money market instruments. So those are the short-term instruments again, and certificate of deposit, that is one of them. And now, as I said, since since no one has watched the video, so some of these things may still be so alien to you. And that's not the intention of the class. The class is intended to basically come to these questions once you have watched, after you've watched the videos. So for today, you excuse the fact that some of these things are not very clear for you. And I'm trying to explain them where I can. But where you don't get something, especially when it comes to these instruments and other issues, you can always go and do a quick search of this on the internet or even in the textbook. It can help you to understand what exactly is a certificate of deposit what's a corporate bond, what's commercial paper, what's treasury bill. But here, what I'm going to do is to see which ones are not money market instruments and then identify them for you. Now, a corporate bond is not. Now, what you need to know about treasury bonds and bills is that when we have treasury bills and then we have treasury bonds. So these are usually government instruments. I'm just using them here and I'm going to tell you what corporate bond relates to. But they are usually government instruments. Like if a government wants to get money from the public, they can sell them treasury bills. But these ones are usually short terms, like less than a year. So those ones will fall under money markets. In fact, you can select them as already part of the money market because they are short term. But the treasury bonds, on the other hand, are long term. So that is more than a year. So those are going to be for long term. And because a corporate bond is an equivalent of a treasury bond, but what companies give out, even these ones are long term and therefore they are not money market instruments. Then commercial paper. So commercial paper, as we shall see, it is the equivalent of a treasury bill for companies. So therefore, it is also a short-term instrument and therefore a money market instrument. So point 1, 3, and 4, those ones are short-term instruments and therefore money market instruments. And the remainders, which is the corporate bond, that is a long-term instrument, and therefore that is a stock instrument, a stock market instrument. So, which few of the following are common roles of the treasury function within a firm? So, when it comes to treasury function, think about the finance department that you have in where you work. What do they do? So those roles are usually similar. Short-term management of resources, that's okay. Long-term maximization of shareholder wealth, that is also what finance manager and finance department will do. Long-term maximization of market share, that is not one of the roles. Because remember this one, we saw that this is not a financial objective, therefore, it's not under the finance manager's docket. Then, when it comes to risk management, that is one of them. Then, receivables and the financial reporting, these ones are not their roles. So if we proceed, which of the following is the difference between primary and secondary capital markets? So now, when it comes to capital markets, there is a primary market, there is a secondary market. Primary market is where the company goes to get money for the first time. So where the company lists their securities for the first time to be bought. Like when MTN was trying to go public, or even Airtel, they went to the stock exchange and put their shares up for selling. That is the primary market. But after they've sold their shares, then people can buy shares and sell shares between themselves or amongst themselves, and that is the secondary market. So that's where they'll trade after they have finished selling the shares for the first time on the primary market. So let's see what that is here. Primary market refers to the sale of new securities, whereas secondary market refers to where securities trade after their initial offering. This is exactly what I've just mentioned. So that is the correct answer. But just to look at the others, both rate where securities are traded after the initial offering, that's not correct. Both is where the new shares are sold, that's not correct. Primary is where the stock are sold, and secondary markets where loans notes are traded, that's not true. So the answer is A. Then we have that changes in monetary policy will influence which of the following factors. So again, we are expecting that by now you have realized what monetary policy is going to do. And remember, fiscal policy has to do with taxation and government spending. Monetary policy has to do with interest rates and money supply. So let's see, level of exchange rates, that is true, because that leads to money supply. Cost of finance. So now, when interest rates increase, cost of finance increases. That's also got to be true. Level of consumer demand. When interest rates increase, people actually save more. And when they save more, they spend less, demand reduces. When interest rates decrease, people are disincentivized to save, but they can borrow more. When they borrow more, they have more money, then they spend more, demand increases. So they can also control demand using monetary policy. Level of inflation. So inflation is to do with the money supply, okay? Again, so that means that the only thing here that is not going to be, actually everything here is going to be influenced by the monetary policy. Exchange rates, cost of finance, demand, and inflation. So the answer here will be D. If they had talked about taxes and government spending, that you would know that that is not going to fall under there, because that is basically fiscal policy. Okay. Which of the following is or are usually seen as forms of market failure where regulation may be a solution? So market failure. So we look at what is given to us, imperfect competition. So now, of course, what you need to realize is that for you to have a good market, there should be competition. Because competition is what lets the sellers never and overcharge you, because if they do, somebody else is going to charge less and you go there. So if perfect competition exists, then that's a good market. So therefore, market imperfection or market imperfect competition means that that is a market failure. So that is one of them. Social costs or externalities such as pollution. That is also a failure of the market. Because the market doesn't fail, then we shouldn't have things like pollution. Usually what happens with pollution is that people are trying to get something cheaper and without looking at the effect of the environment. So that is market failure as well. Then suppliers agreeing between themselves to set minimum sales price. That is actually what we call cartels. So cartels, but not just cartels, because it's not really about minimum prices, but they can also set maximum prices. But that's not even a good thing. About if suppliers can sit and say, how much should we charge these people? Then the market has already failed. So all the three items that have been highlighted here can indicate that the market has failed, and therefore we need to have some regulation. So that's why the government then would come out and say we should not allow monopolies to form. For example, here Uganda has failed on that because there's only two providers of telecommunication services, MTN and Airtel, that are serious. So that's the duopoly that government either has failed to control or is not trying to control. Either way, it means that the people are going to not be experiencing cheap costs when it comes to, for example, internet and telecommunication, like phone calls. There are some countries, Uganda is one of those countries with the most expensive data packages. And the reason is that other countries have many providers of internet, whereby right now they are starting to do it for the internet, at least for the fiber optics and all that, for the fiber cable. But when it comes to telecommunications, really like GSM calling and all that, MTN and Airtel, they are the big ones. So that is what government would try to break apart by encouraging other players to come and all that. If we continue, there are two main types of financial markets: capital and money markets. Like we said, of course, the capital markets are the ones that we are also calling the stock markets. And each of those ones have their primary and secondary markets. And I was saying which two of these ones are correct. So here, what we want to do is to see what we are looking out for: primary markets, secondary markets, capital, and money markets. So primary markets allow the realization of investments before their maturity date by selling them to other investors. That's not what primary markets do, because we said that's where you go and raise finance or sell your securities for the first time. They deal in new issues. That is correct. Capital markets consist of stock markets for share and loan bond markets. So I think we have already been talking about that. I've talked about capital markets being also called the stock markets. So this is correct. Then money markets provide long-term debt finance. That's not correct, because money markets only do short-term. So the answer is going to be B and C on that one. And then indicate by clicking on relevant boxes whether the following statements are true or false. So the first one says interest rate smoothing is the policy of some central banks to move official interest rates in a sequence of relatively small steps in the same direction, rather than waiting until making a single large step. Now, I know that you do not know about this at the moment, and perhaps you will know when you watch the video. But if you read the statement and you reason it out, you can get the answer without having to have read this. You see, when they say smoothing, imagine one time you wake up and the interest rates are 10%. Then the government says now interest rates are 20%. Everybody would go to the streets, okay? Because that's a big jump. But now imagine government says interest rates have increased to 11.2%. And then after some few months, 11.3%, like that. They take small steps, incremental steps, until they reach the desired. That is what we call smoothing. So this statement is correct. And if government wishes to influence the amount of money held in the economy or the demand for credit, they may attempt to influence the level of interest rates. And I already explained this, is that when interest rates increase, it becomes beneficial for you to save money, because you earn more when you save. And that means that you actually save more and spend less. Okay? And when interest rates decrease, then it means that it's easier to get a loan, but not beneficial to save. So people will actually eat their money and, in fact, get even loans and spend more. So those are things that are going to reduce the money supply. So that's also correct. But money supply depends on how much people are spending vis-a-vis how much they are saving. Okay, so let's go on. So they are saying that a variety of corporate governance rules have been introduced in different countries, but what are the principles common to all that they typically include? So here, this question is again back on corporate governance. So they are looking for what is typically found in the corporate governance codes of most countries. So you don't have to know anyone specifically, but the one that they normally teach in the textbook is one for UK as an example. So you can use that one to understand basically the rest of it. So let's see. Chairperson and chief executive should not be the same individual. That is what I talked about one time before. So that is correct. Then non-executive directors on the board should prevent the board from being dominated by executive directors. That is also correct. The audit committee should consist of executive directors. So this one, you know it's wrong because we already talked about the audit committee and we said it should have independent non-executive directors. And then finally, nomination committee should be established to decide on the nomination of executive directors. And that is correct. So when you look at those committees that are there, you have the audit committee, you have the nomination committee, and then those committees in there they explain to you what each of them should have and how they should operate. So point 1, 2, and 4 are correct. So that is part C. Then the following statements is correct. Direct taxes are levied on one set of individuals or organizations, but may be partly or wholly passed on to others and are largely related to cash consumption, not income. So now this one is to do with taxes. So basically, we are looking at a little bit deeper in the fiscal policy. So now, okay, now this one, I'm certain that Priska can answer it for us, given that it's to do with taxes. So direct taxes, if we go to it, are levied on one set of individuals, organizations, but may be partly or wholly passed on to others. And this is not correct, okay? Because direct taxes actually cannot be passed on. That is what indirect taxes are. So like VAT. Indirect taxes are levied directly on income receivers, whether they are individuals, organizations. So that is not correct. Indirect taxes are not directly levied on income receivers. They are usually levied through, like for example, when you have VAT, VAT is passed on to the final consumer, which is the income receiver, but it passes and it is paid by the consumer, the final consumer, which usually is an individual. Companies usually pass it through to the consumer, except when the company is the final consumer. So then a balanced budget occurs when total expenditure is matched by total taxation. And then a deficit budget occurs when total expenditure is less than total income taxation income. So here we look at these two aspects, and we are looking at a budget. And this budget here looks at government's budget. So government's budget, ideally, if you look at the one we have in Uganda, ideally you would want to have income from taxation equal to the expenditure. you incur for the public services, such that you don't have a deficit that will causes you to borrow money. So that is what the statement C is saying, that a balanced budget is when total expenditure is matched by total taxation. So that's the correct answer. And a deficit one is when expenditure is actually more, not less. Okay, if you spend more than you earn in tax, then deficit, like how we are here in Uganda. And I think we shall stop at question 38, which says indicate by clicking whether the statements are true or false. And basically, it is bringing back the two aspects we saw of the inflation. So let us see. Demand pull inflation. So we said that demand pull inflation might occur when excess aggregate monetary demand in the economy and hence demand for particular goods and services enables companies to raise price and expand profit margins. So what I said last time was that if demand increases for something, then people can increase prices, and that causes inflation. And that's what they're saying here. When excess aggregate monetary demand in the economy, when there is excess aggregate demand in the economy, okay, so people want, in this case, it's not goods, but money. So there is monetary demand. So for example, if you see that there is a lot of demand for dollars, then the price of dollars is going to increase. And when the price of dollars increases, usually inflation follows. So that is correct. Then on the other hand, cost push inflation occurs where there are increases in the production costs independent of the state of the demand, okay? This is also something we saw already up, which says that, okay, if there is inflation, but it has nothing to do with the demand changing, then that is usually cost push inflation. So unless you have some questions for me, we are going to stop here. So we have left questions from 39 up to 54. Okay, so those questions that we have not handled, you should do make it a habit so that you can attempt them, so that you can get to see whether there are some aspects that you don't understand yet. And I'm going to share with you the video so that you can watch it, but as well share with you a link that you can use to register and you access Google Classroom classes. And all you need to do is to log in your Google account. And I know everybody has a Google account. So I'll do that. Then I also share with you for now the video for next week so that you can actually get started on that. So if there are no questions, I'll stop here. Have a good night and see you next week. Yes, Julius, you have a question?
I'm actually okay. Thanks, Herbert.
Yeah. So have a good night. See you next week.
See you.